Hey everybody, Smart Silver Stacker here. Hope you're doing well. Earlier this week, we kicked off a significant rally in the price of both gold and silver. And to me, the most interesting part about this rally is what triggered it, because it all started when the Bureau of Labor Statistics released June's inflation data, which revealed a significant cooling in the US inflation numbers. But why would weaker inflation cause gold and silver to rise? Well, it's because cooling inflation has got investors convinced that the Fed is now near the end of its rate hiking cycle. They believe the period of tighter monetary policy is coming to an end. But today, I want to talk about a growing crisis in the US economy and a major red flag for the US dollar that investors seem to be ignoring, because this one number alone could be what makes the Fed not only end its rate hikes, but slash rates drastically and return to stimulus and money printing, the likes of which we have never witnessed. And when they do, the explosion in the price of gold and silver will make this week's rally look like child's play. So, let's get to it. Thanks for tuning in today, everyone. If you enjoy this video, please do give it a big thumbs up down below. And while you're at it, why not subscribe to the channel? And I also do want to let you know I have teamed up with today's sponsor, Gold Mining Inc., to bring you this video. More on them later. But now, let's get right into this massive red flag for the US dollar. And it's not exactly a secret. It was published right here in the latest monthly statement from the US Treasury. But it's not on the front page of the report. No, we have to go to page 9 to table 3, summary of receipts and outlays of the US government, June 2023 and other periods. Down to this line here, Department of the Treasury, gross interest on Treasury debt securities. And according to the Treasury's own report, we can see that so far in fiscal year 2023, the Treasury has already paid $652 billion in interest. And right next to it, you can see that last year's number from the same time period was $520 billion. So this represents a greater than 25% increase in interest paid by the Treasury on a year-over-year basis. And this alarming trend of skyrocketing interest costs on the massive US national debt is confirmed by this chart from the St. Louis Fed. You can see that interest paid by the federal government is now going parabolic. And the scary part is that this interest cost is only going to get worse even if the Fed stops hiking rates immediately, because many of the current outstanding treasuries are lower yield short-term bonds that were issued back when rates were much lower. But every single month, more of those low-yield US bonds are getting rolled over at the new higher rates. Just consider for a moment that if the entire $32.5 trillion US national debt was rolled over to the current yield on, say, a 10-year treasury of 3.8%, the interest cost on the debt would soar to over $1.2 trillion annually. That would exceed spending on Social Security and Medicare, and interest would become the single largest item in the federal budget. And that is exactly where we are headed. The situation here, it's clearly not sustainable. Even the Congressional Budget Office's own forecast reveals that the U.S. debt relative to GDP is set to explode in coming decades. And I suspect that these projections paint a far rosier picture than what we are actually going to witness. In fact, I believe that as the interest costs continue to mount and federal deficit spending continues to grow unabated, the Federal Reserve will ultimately be forced to intervene in these markets to lower interest rates, and they will do this by monetizing vast amounts of US debt through quantitative easing. Now, what crisis will the Fed use as cover for their intervention this time around? Well, I don't know. I don't have a crystal ball, but I don't think that we're going to have to wait long to find out, because when I look at these astonishing debt and interest figures, one thing becomes clear, and that is that the only way to pay off a debt of this magnitude is in devalued currency. And when the next financial crisis rears its head and the Fed's return to ultra-easy monetary policy becomes apparent to investors, hard assets like gold and silver will be the safe havens that everybody flocks to. That could be why central banks around the world have been buying up gold for the past year at the fastest pace on record. And it's also certainly a motivation for the global trend towards de-dollarization that we are witnessing as foreign holders of US dollars and US dollar denominated debt look to reduce their exposure to this devaluation risk. And all of this is why I believe that despite the recent rally in the price of gold and silver, both metals are still incredibly cheap. And when markets realize just how serious this debt crisis is and how it must ultimately be resolved, the price of the precious metals will absolutely explode. Of course, that's just my forecast, but it is what I am betting on. Now, how high could the metals go? Well, it's hard to say because, it's going to depend on how much inflation the Fed unleashes. But I think that new all-time highs for both metals is a very real possibility. And if we just take a look at the previous all-time highs for gold and silver from January 1980 and adjust them for inflation, that gives us an all-time high for gold of over 3,300 of today's dollars, and for silver, it's over $190. Now, I don't believe that anyone can accurately forecast an exact price target for gold or silver, but when you look at the relative value of precious metals to other assets, such as stocks, for example, as we see here in the Dow to gold ratio, you can see that metals are tremendously undervalued at today's prices, and there is plenty of room for price appreciation. Now, let me tell you about how I am positioning myself for what I believe will be a huge bull market in the precious metals. Keep in mind, none of this is financial advice. I'm not a financial advisor, but for me, stacking physical precious metals, the gold and the silver, that is the top of my list because there are many reasons to hold physical metals. You've got the lack of counterparty risk, the ability to take control of your wealth outside of a manipulated financial system, and the fact that you can hedge against risk and inflation with assets that have preserved value for literally thousands upon thousands of years. But for those of us who can tolerate a higher level of risk in exchange for leverage to the price of gold and silver to not only preserve wealth, but even to grow it, adding some mining stocks to the portfolio is worth examining. And today, we're going to talk about a junior miner, Gold Mining Inc., New York Stock Exchange ticker symbol GLDG, that I believe offers just that, an undervalued asset with the potential to produce gains significantly greater than the moves we will see in the spot prices of gold and silver alone. I have talked a lot in the past about how undervalued I think gold and silver are at today's prices, and that is a big part of the reason why I stack them. I like to buy assets when they are unloved, when they are cheap. And right now, Gold Mining Inc. looks incredibly undervalued for what you are buying. Right now, the company has a total market cap of $157 million. Now, they also own 20 million shares of a gold royalty company. Those are worth about $36 million. And they own shares in a gold miner based in Alaska that are worth $112 million. So when you subtract their combined holdings in these companies of $148 million from their market cap of $157 million, you have $9 million left over. So what is the market assigning that $9 million valuation to? Well, Gold Mining Inc. has 13 gold projects throughout the Americas with 22 million ounces of gold resource in the ground. The industry standard for valuing gold resources in the ground is about $30 an ounce. So at that price, the industry standard, Gold Mining Inc.'s 22 million ounces of gold resource would be valued at approximately $660 million. But right now, markets are valuing those resources at $9 million. Now, when you see a valuation so incredibly low, and then you also factor in that Gold Mining Inc. has a strong cash position and also no debt, to call this company undervalued is a massive understatement. Analyst price targets of more than $5 per share reflect just how cheap the company is at today's prices, with shares currently trading for less than 95 cents. But one major difference between stacking physical metals and investing in the miners is the human element. Gold Mining Inc. has a world-class leadership team with significant experience. The company's co-chairman is the former CEO of the world's largest gold miner, and Gold Mining Inc.'s CEO is an expert at advancing gold projects. Currently, they are advancing 3. So when you consider just how cheaply the market is valuing Gold Mining Inc.'s gold resources, along with their experienced team, strong balance sheet, and favorable geographical location, it's clearly one of the miners that should be on every gold and silver bull's radar. Now, don't go out and invest in Gold Mining Inc. just because you heard about it here. Make sure you are doing your own due diligence. A great place to start and to find more information about Gold Mining Inc. is by visiting goldmining.com. And I will put a link down in the description for you to check that out. And I do want to say a big thanks to all of you for tuning in today. Big thank you to today's video sponsor, Gold Mining Inc. And I would like to know what you think about the future of US interest payments, US debt, and gold and silver as investments. Leave me a comment down below to let me know. Stay safe and happy stacking, everyone. Smart Silver Stacker, out.